This video is a preview of our course lesson. Please visit myconsultingcoach.com to access the full version. We all know that the objective of every business is to make a profit, and that it will ultimately be the role of the consultant to maximize that profit. In this video, we will be examining the idea of profitability in some detail. We will begin by learning about the components of profit, revenue, and cost in some detail. Revenue can be seen from 2 points of view. The supply-side definition of revenue is the income of a company over a certain period of time, typically 1 year. By contrast, the demand-side definition is the total amount paid by customers in order to obtain a particular product or service from a company over some period of time, again, typically 1 year. Every company is different and each has its own specific revenue structure. To take some examples, in a call center, a certain price per minute is applied. A cheese producer will charge a price per gram for their cheese, whilst a consulting firm will bill a price per day for a consultant's time. Each revenue structure can always be represented by an equation. The most basic revenue equation is simply the unit price multiplied by the quantity sold. Whilst this equation would refer to a company which sold only one product at a fixed price, equations can also be more complex. The complexity of the equation reflects the complexity of the company's revenue model, but it always boils down to a price times unit function. If a company were to sell many different products and services at different prices, then the equation would have many parts, as it would be the sum of the individual revenue streams derived from each product or service. A good way to set out a revenue breakdown is by using a tree structure. We will look at some examples in the next few pages. As we have just seen, the simplest revenue structure corresponds to a company selling only a single product or service at one price. In this case, we noted that the revenue will be equal to the unit price multiplied by the number of times the product or service is sold. We can represent this revenue structure with the tree we see here. An example of a business with such a simple revenue structure might be a stand selling only hot dogs. The stand's revenue for each day will be equal to the price of an individual hot dog multiplied by the number sold. Of course, usually companies will sell more than one product. Each additional product or service brings with it an additional separate revenue stream. Here we see the example of a company which has two revenue streams by virtue of selling two products, A and B. Returning to our hot dog stand, we can imagine the owner decided to also stock small bottles of cola. The same revenue will still come from selling hot dogs, but there will be additional revenue from selling the cola, with this being equal to the price per bottle times the number sold per day. To find the stand's total daily revenue, we take the sum of the two revenue streams. Another way for a company to have two or more revenue streams is for it to vary the price of a single product for different customer groups. This is called price discrimination. In fact, it is very common for the companies to sell the same product at different prices to different customers. Take, for example, two identical apartments sold to two buyers at different prices. Alternatively, a manufacturer of car components might discount its products for customers purchasing large enough quantities. Airplane seats are also sold at different prices depending on how far in advance they are booked. Price discrimination allows companies to make some customers pay a higher price exactly when those customers can afford it. At the same time, those customers who cannot afford the high price will still be able to buy the product, but at a lower cost. From the company's point of view, this is ideal, as it allows them to maximize revenues. However, from the point of view of the customer, it can be very frustrating. An interesting example of a revenue structure is that of a call center. A call center charges a price per minute for calls. Here we still work with the price times unit structure, but we will break down the price component one level deeper. Let's look at the price first. The average revenues per call is calculated as the price per minute times the length of the call in minutes, with this taken as an average. The quantity component is just the number of calls in a specific period of time. The total revenue is calculated by multiplying the revenue per call by the number of calls. Another interesting example is the revenue structure of an insurance firm. For an insurance company, revenue is provided by the price, in this case called premium paid by customers, known as policyholders. The total revenue then is found by multiplying the average premium by the number of policyholders. This basic revenue scheme for insurance can be made more complex. The premium charged by the policyholder will usually vary based on the degree of riskiness of the policyholder. As such, low-risk clients will pay a lower premium, whilst high-risk clients will pay a higher premium for the same insurance product. So our revenue driver tree is driven by the different customer segments, in our case policyholder group A and B. Take, for example, a car insurance provider, which might wish to charge a higher premium for riskier drivers. Now let's have a look at costs. A company's costs are a measure of the resources it utilizes in order to conduct its operations. Costs are paid by the company to its suppliers, workers, service providers, and other agents. As with revenue, each company has its own distinct cost structure. Costs can be segmented in two different ways, either into fixed and variable costs or according to a value chain approach. Let's start with the first way to segment costs, into fixed and variable costs. As with revenue, our segmentation can be represented with a tree. The first branch of the tree is for variable costs. Variable costs increase or decrease based on the quantity of products produced. They can thus be calculated as the quantity times the unit cost. An example for variable costs are material costs needed to build a product. The more products you build, the more material you need. The second branch is for fixed costs. These are independent of the quantities of product produced and are expressed as an absolute number. They are an overhead that is paid to run the business and are, to a certain extent, independent from production. An example for fixed costs are utilities. Companies typically have a close eye on their fixed cost level because in a downturn, when revenues decline, variable costs also decline, but fixed costs remain. We will talk about this in some more detail in just a minute. To understand this better, let's look at some examples of typical fixed and variable costs. Variable costs include the inputs required for production, such as raw materials. They might also include packaging and transport for products. Fixed costs include things like rent, utilities, SG&A, and labor. It should be noted that labor can actually be considered as either a fixed or a variable cost. As such, when solving a case, you should explicitly mention whichever you assume and why. For example, you might say that given a case is set in Europe and European regulations tend to make it difficult to lay off workers from one day to another, you will assume labor to be a fixed cost in this instance. It is interesting to examine fixed and variable costs from a mathematical point of view to see how their behavior differs as production increases and decreases. Let's start with variable costs. A variable cost is the cost incurred to produce a single unit of product. Therefore, increasing or decreasing the quantity produced will cause variable costs to increase or decrease at the same time. We can say that variable costs are proportional to quantity, that is, they display a linear relationship as shown in the graph. We can express this as total variable cost equals variable cost per unit times total quantity. As an example, let's imagine a cheese factory. For such a factory, one of the main variable cost components will be milk. It is clear that if we want to double the amount of cheese produced, we will need to double the volume of milk we input as well. Fixed costs behave entirely differently in response to increases or decreases in production. In fact, as fixed costs are independent of quantity, they do not change at all in response to increases or decreases in production. Graphically, this is represented by a horizontal line. For our cheese factory, rent needs to be paid for the factory and office buildings, regardless of productivity. If the factory is unlucky and experiences a fall in cheese sales, its rent will still have to be paid at the same rate. However, if the factory is doing well and wants to double cheese production, new workers will need to be hired, new machines bought, and perhaps a larger factory space rented. Thus, fixed costs will, in fact, change with large changes in the quantity of production. This behavior is shown by the steps in the graph here. The steps show us that fixed costs are constant within a certain interval of production. However, when production quantity increases or decreases significantly, fixed costs will move up or down to another step. It is generally impossible to move from one step to another in the short term. Acquiring a new factory and machinery might take months, for example. This is why we usually treat fixed costs as constant. When solving a case interview, fixed costs are always treated as constant. However, it is important to note that if you were to consider a longer period of time, they can also be changed. Finally, we are able to put together fixed and variable costs in the same graph so that we can find the total cost. The graph of total cost is a line with the same gradient as the one we saw in the variable cost graph, but cutting the vertical axis at a level corresponding to the value of the fixed costs. Total costs depend upon both fixed and variable costs and can be expressed as the sum of those two values. In full, then, total cost equals fixed cost plus variable unit cost times quantity. The alternative way to segment cost is to adopt a value chain perspective. We can think of the value chain as an imaginary chain of different activities connecting each step required to produce a product and eventually deliver it to the final customer. In this context, we are interested in those links of the chain owned by our client's company. The image shows a value chain for a typical manufacturing firm, with these focal links highlighted in green. Each activity has its own costs, including both fixed and variable costs. Let's look at the cost corresponding to each link in the chain shown. First, let's look at the upstream part of the value chain. Raw materials and other necessary resources have to be sourced from suppliers, which are upstream of our company in the value chain. The costs here are those resulting directly from the acquisition of resources, as well as the cost of managing the relationship with the supplier. This including things like the initial search for a supplier as well as any transaction cost after they are found. Internally, a manufacturing company will mainly sustain costs from inbound and outbound logistics and production. Besides these, though, we mustn't forget the internal costs of supporting activities such as HR and R&D. Typically, those costs are called overhead because they are not allocated to single units of production. Finally, there will be costs required to reach buyers, such as those of getting products in the desired channels. These are typically marketing and sales costs. There will also be costs to manage the relationship with those buyers, such as transaction costs, after-sales service, and retention activities. Having learned about revenue and costs separately, we are now ready to combine these ideas to arrive at a definition of profit. Profit can be thought of as the synthesis of revenue and cost. What is left after you deducted all costs from revenues is the profit. If costs are higher than revenues, then we have a negative profit, which is called a loss. Profits represent the value generated by a business over a specific period of time. Typically, the main objective of any business, and thus of our clients, is to maximize profit. When discussing profit, there are two concepts which it is most important to know. These are profit, also called net profit, and profit margin, also called profitability. The two differ in that profit is given as a monetary value, whilst the profit margin or profitability is given as a ratio or a percentage. Profit is calculated as the difference between total revenue and total cost over a specific period of time, typically 1 year. In effect, it answers the question of how much revenue is left after costs are subtracted. The profit margin, or profitability, is the ratio between profit and revenue. It is usually expressed as a percentage and answers the question of what percentage of revenue is yielded as profit. The profit margin is a helpful indicator when you want to compare different companies within the same industry. Another important concept in this area is the contribution margin. The contribution margin is calculated by applying the profit equation to a single product. Thus, the contribution margin is found by subtracting the variable unit cost from unit revenue. Note that fixed costs do not impact the contribution margin. After all, producing only one additional unit will not alter our fixed costs. The contribution margin is the answer to the question of how much the company can earn by producing and selling one additional unit of product. As with profit, the contribution margin is expressed as a monetary value. Starting from the contribution margin, it is possible to calculate the total profit. Let's work through these steps. First, we can work out the contribution to total profit from each product by multiplying that product's contribution margin by the number of units sold. Second, total profit is calculated by summing the contributions to a total profit of each product and deducting fixed costs. Breaking down the profit of the company into the contributions of each product allows us to compare different products and see which contributes more to the company's total profit. Let's consolidate what we have just learned with an example. Golden Apfel is an Austrian company producing juices and being particularly well known for its apple juice. Each bottle of apple juice is sold for €5, whilst other flavors are sold for €3. The major cost components are labor, fresh apples at 25 cents per apple, and fruit puree at 5 cents per gram. 4 apples are needed to produce a bottle of apple juice, and 40 grams of fruit puree are required to produce a bottle of another flavor. The company has 5 full-time workers who receive €20,000 annual salary. During the year 2000X, 30,000 bottles of apple juice and 20,000 bottles of other flavors are sold. Now, what is the profit or loss of Golden Apfel in the year 2000X? A tree diagram will be useful to understand the problem. Draw the tree for profit. We will first calculate revenue, then costs, and then finally arrive at our final answer by performing the synthesis of these two values. Start building a tree structure for the revenue component. There are 2 revenue streams, one for apple juice and one for the other flavors. Each of these revenue streams can be calculated as equal to the number of bottles sold times the price per bottle. It is easy now to start filling up this tree with the numbers that we already know. Recalling the text of the problem, we read that during the year, 30,000 bottles of apple juice and 20,000 bottles of other flavors were sold. Each bottle of apple juice was sold for €5, whilst other flavors were sold for €3. Now we can perform the calculations to complete the tree and calculate the total revenue. 30,000 bottles of apple juice sold times €5 per bottle equals €150,000. 20,000 bottles of other juices sold times €3 per bottle equals €60,000. €150,000 plus €60,000 equals €210,000, which is the total revenue of Golden Apfel. Let's move to the cost side and develop another tree structure. As always, cost can be segmented into variable and fixed. The variable cost can be differentiated into apples and fruit puree, these being the main raw materials of production. Each of these is the product of their unit cost and the quantity used, with this calculated as the quantity per bottle times the number of bottles sold. Moving to fixed cost, the main component is the workforce. This is calculated as the unit annual salary times the number of employees, assuming that each is paid the same. By summing the variable and fixed costs, we arrived at the total costs. Again, we can start filling up our tree with the numbers we already know. Recalling the details of the case, the major cost components are fresh apples at 25 cents each, fruit puree at 5 cents per gram, and workers' pay. 4 apples are required to make 1 bottle of apple juice, whilst 40 grams of fruit puree are needed to produce each bottle of the other flavors. The company employs 5 full-time workers receiving a €20,000 annual salary. Now we perform the calculations, moving from the right of the tree to the left. Finally then, we can sum the values for the variable and fixed costs to arrive at the total costs. In order to finally calculate the profit or loss, we must return to the original profitability tree. The values which we have just calculated for Golden Apple's revenues and costs can be filled in on the branches of the tree. Given that the revenue is higher than the cost, we already know that the profit value will be positive. By subtracting the cost from the revenue, we find that the exact value for the profit of Golden Apple is 40,000 euros. We can also calculate the profit margin. This is done by dividing the profit by the revenue. In this case, we obtain a profit margin of about 20%. Additionally, we can calculate the different contributions of each product, that is, of the apple juice and the juice of other flavors. The contribution margin for apple juice is calculated by subtracting the variable cost for producing one bottle of apple juice from the revenue derived from selling one bottle of the same juice. The contribution margin for apple juice can then be multiplied by the number of bottles sold to give us contribution of apple juice to the total profit. The same is also done for the juice of other flavors. The contributions margins show that for each bottle of apple juice sold, the company earns 4 euros, whilst for each bottle of another flavor sold, the company earns 1 euro. As such, it makes good economic sense to focus on selling more apple juice bottles. In absolute terms, sales of apple juice contribute 6 times more than the other flavors to the company's total profit. Let's look at another example. This time, we will focus on answering the question, what is the impact of producing one additional unit on profit? Our client is the CEO of the Watchco company, a watch manufacturer. He has to make an important decision as to how many watches to manufacture. 2 scenarios are possible and are described in the page. In scenario 1, the selling price of watches is $120 each, with variable production cost running at $100 per watch. The factory's capacity is 1,000 watches per year, with this fully satisfied by demand. The fixed annual cost of running the factory is $50,000, to be paid only if production starts. In scenario 2, we have similar circumstances. Again, the selling price of a watch is $120, with production cost of $100, and factory capacity remains at 1,000 watches per year, fully satisfied by demand. However, now the fixed costs of $50,000 for the factory have already been paid at the beginning of the year. The data we have is sufficient to calculate the contribution margin per unit, total profit without production, and total profit with production for both scenarios. In particular, note that in scenario 1, if Watchco chooses not to produce, it will not incur fixed costs, whilst the variable costs are, by definition, 0. Instead, if it chooses to produce, it will have a positive total contribution margin of $20,000, given by a $20 contribution per watch multiplied by 1,000 watches produced. However, starting production will require the company to pay $50,000 of fixed costs. That will make the decision loss-making by $30,000. Therefore, if fixed costs are to be paid only if the company decides to produce, it would be better off by deciding not to produce any watch. In scenario 2, since fixed costs have already been paid, the company should take the opposite decision. Maximizing production would maximize profit or minimize losses. Producing one additional unit yields a positive contribution margin in both scenarios. If the contribution margin was negative, so that the selling price did not cover the variable costs, then production should always be 0, as it only generates losses. However, if fixed costs were already paid regardless of any decisions made about production, producing as many as possible, that is 1,000 watches, would minimize loss, since the contribution margin is positive. The Watchco example answered the crucial question implicit in production problems. What is the effect of producing one additional unit on profit? Often, companies will have to make decisions about production without the possibility of changing the fixed cost base in the short term. This will be the case because, whilst the price commanded by products in the market might change quickly, the fixed cost structure of the business might take a long time to change. For example, selling a plant or buying a new machine can take several months. So, how should companies think about how much to produce? A company should take its decision based on its contribution margins and the possibility to change the fixed cost structure. If contribution margin is negative, production should be zero, because it can only generate further losses. If instead contribution margin is positive, we should look at our fixed cost structure. If we can change our fixed cost structure, meaning that we can choose whether to incur fixed costs, we should understand whether profit when producing at full capacity is greater than zero. That means checking whether our total contribution margin, given by unit contribution margin times quantity, is higher than our fixed cost. If so, we should maximize production, otherwise we should not produce at all. If instead we cannot change our fixed cost structure, as in scenario 2, we should only maximize production since fixed costs were already paid. We will now introduce a new concept, the break-even point, or BEP. The break-even point is an important metric to apply in understanding a company's profitability. It is defined as the number of units a product will have to be sold for the profit to be equal to zero. At the BEP, profits equal zero and revenue is equal to costs. Graphically, the break-even point can be shown as the point where the lines representing cost and revenue intersect. At this point, the value for quantity can be indicated by Q star. Thus, when the quantity of products sold equals Q star, revenue and costs are equal and we are at exactly the point of breaking even. Let's make things clearer with an example. Let us imagine that our client Gigi is new in town and is thinking about opening a coffee shop. Throughout his first year of activity, he is planning to sell only one type of coffee, a short black espresso. Gigi estimates his fixed cost to be $10,000 per year and his variable cost to be 50 cents per coffee. If he is planning to sell his coffee at $1, how many coffees does he need to sell in order to break even? As usual, we will begin from a tree diagram of the business's profits. Revenue is calculated by the unit price times the quantity sold, and costs are divided into fixed and variable. We calculate profit by subtracting costs from revenue. To calculate the break-even point, we set the profit equal to zero. We already know some of the relevant data to fill in our tree. Specifically, we know that Gigi estimates his fixed cost to be $10,000 per year and that his variable costs are 50 cents per coffee, whilst he is planning to sell those coffees for $1 each. As we can see, the quantity value is still missing. However, we have enough elements to calculate the quantity in such a way that profit is equal to zero. We need to build and solve the profit equation with the profit value set to zero, meaning that revenues will be equal to costs. The first step is to write down the equation without numbers, that is, price per coffee times quantity equals fixed cost plus unit variable cost times quantity. The second step is to substitute in the numbers we have and solve for the quantity Q. Thus, $1 times Q equals $10,000 plus 50 cents times Q. Solving, we are left with Q equaling 20,000 units. We can conclude then that in order to break even, Gigi must sell 20,000 coffees per year. In the graph, this is the point where the lines representing revenue and cost intersect. Here, revenue and cost are exactly equal, making the resulting profit equal to zero. If Gigi sells more than 20,000 coffees, he will make a profit greater than zero. This corresponds to the region of the graph to the right of the BEP. If he sells fewer than 20,000 coffees, though, Gigi's profit will be less than zero, a loss, corresponding to the region of the graph to the left of the BEP. We can confirm our result by plugging the value for quantity equal to 20,000 into our tree. If we perform the calculations from right to left, profit equals zero, which is correct at the BEP. The break-even point can also be assessed in terms of the contribution margin. This method is called cost volume profit or CVP analysis. This provides a more immediate way to evaluate a business's profitability. In a CVP analysis, revenue is expressed as unit contribution margin plus variable unit cost times quantity. Profit is then equal to the contribution margin times quantity minus fixed costs. Since the break-even point occurs when profit is equal to 0, it follows that a shortcut to calculate the break-even point is to divide fixed cost by the unit contribution margin. Let's return to the example of Gigi's Coffee to see the cost-volume profit method in action. Gigi's fixed costs are $10,000. The contribution margin for each of his coffees is given by the difference between revenue per unit, that is, the price charged, and the variable unit cost. This is $1 minus 50 cents, which equals 50 cents. Dividing the total fixed cost by the unit contribution margin allows us to find the BEP. Thus, we divide 10,000 by 0.5 and get the correct answer of 20,000 coffees. The advantages of CVP analyses are clear in that they make for quicker calculations to give us an immediate snapshot of a business's profitability. Our next concept is the issue tree, which we will introduce through an example. Let's imagine that we have a case where the client has called us because they are experiencing declining profits but do not understand why. Interested? Watch the full video and many more in the My Consulting Coach Academy, our end-to-end case and fit interview course, and learn to tackle problems in the same way real consultants do. Now, you may wonder, what is so special about the My Consulting Coach Academy? First, the idea behind it. 20 top ex-consultants from McKinsey, BCG, and Bain developed this course to set a new standard. We teach you to build tailored solutions to case problems rather than force-fitting some ready-made frameworks. Second, the breadth. We cover all topics related to the consulting interview, leaving nothing off the checklist. Required fundamentals, systematic case cracking, quick calculation tools, fit interview stories, and much more. We've got you covered. And finally, the active learning. We created more than 200 exercises to test your skills in the most critical areas of case interviews, including structure building, critical reasoning, analytical problems, and full cases.